On Q3, the first point here is say that we had a positive EBITDA of 100K, and this is the first time that we deliver a positive EBITDA since Q2 2023. You can see in the right side here of the chart also the EBITDA in each quarter since then. So we expect this improvement keeps going on, and then just better year-on-year comparison from now onwards. On sales volume in Q3 2025, we had 85,000 tons, a 16% reduction compared to Q3 2024. In terms of revenue, the company had 5.9 million Canadian dollars in revenue. It was an 18% decrease compared from the same period. In terms of gross margin, excluding freight, we can see in another chart that we have both gross margin with freight and without freight. You can see that we were in line with 2024. It's a good news. And freight is something that really impacts our results since it's accounted in the revenue, but not in the cost since it does SG&A. So for this reason, it's good to always analyze with and without freight the gross margin. So like I said, in this situation here, we had a flat number of 60% on GM compared to last year. In terms of net loss, we had an improvement, a reduction in our loss from 2.3 million last year to 2.1 million this year. And this reason, one of the key reasons we see in the coming charts as well, that it's due to our bad debt provision reduction. In terms of cash, we had on hand a bit more than last year, 3.6 million Canadian dollars. However, it was mitigated by our receivables in the quarter from 11.3 to 7.9 million delivered in Q3 2025. And also another good news that we have already disclosed is that during the period we were granted with a new patent related to microorganisms, and then now Verde has 5 patents and another 3 applications pending. So this was also an achievement in the period. In terms on financial operation results, one of the key points that I need to highlight here is the allowance of expected credit losses, which is the old bad debt provision. We had a significant improvement from the prior period of close to 80% from $785,000 to $163,000. And this is mainly driven by a rigorous credit approval policy that we've implemented since the beginning of the crisis, which was like mid of 2023. And now that we are able to see that the results, in one hand, it reduces this bad debt provision, but on the other hand, of course, we lose also sales, and this impacts our company in the top line in the short term. But we believe that in the long term, that's the correct decision and strategy to avoid late receivables and avoid new bad debt provisions in the coming periods. So as I've mentioned before, we had a net loss improvement from 2.3 negative number in the period to 2 million in the current quarter. In terms of operation summary, in tons, the first chart here, the first table, we can see the numbers including freight, as I've mentioned, and we can see the key numbers per ton. We delivered a slightly improvement here in terms of cost, but on the other hand, we lost a bit on the revenue per ton, and this was mainly driven by Brazilian real devaluation in the period. And then, as I've said, we had a gross margin of 75%, including freight. But when we exclude freight in the last line of the chart, we can see an average gross margin of 6%, which is a quite good gross margin. And is a sign that we do have very large capacity compared to what we are currently selling. And expectations when we are able to leverage our volumes is that we deliver a lower cost per ton. We do have some costs to be diluted, and of course, as you can see here in the SG&A, most of those costs here are fixed, except on fee paid to sales agents, among some others. But most of the costs here are fixed, and once we grow in volume, this will be a very good news for our bottom line results. On this line here, we can say that in sales and marketing expenses, we had a slight improvement, but was offset by the fees paid to sales agents. This is part of our strategy. We switched last year from some full-time employees to other type of sales agents in the field. These people and this sales force, they work normally with higher level of commissions, but at the end of the day, they have lower fixed costs. So for the company, we believe that's the good correct strategy for the coming periods as well. In terms of general expenses, we had a 9% improvement from $1,054,000 last year to $955,000 this year. We can see here that most of it was driven by a legal professional consultancy. We had some achievements made in terms of accountant firms, for example, and among other consultants that we used to have from UK, from the prior period when the company used to be based in UK or Singapore, and some important reports and analysis we are doing internally in Brazil at this point. So this also helped us to reduce SG&A expenses, which is one of our focus at this point and since 2023.